Investing in the stock market has never been easier, but it's crucial to understand the risks associated because even a blindfolded monkey could select a portfolio that would do just as well as ones carefully selected by experts. Now, if you don't know what ETFs are, they're pretty much a way to buy a variety of different investments all within one purchase. And with the 6 ETFs I'm about to show you, they provide the potential for significant growth while containing great diversification, which can reduce the downside risk, especially when compared to picking individual stocks. All in all, typically investments with a higher potential reward also come with a higher potential risk, so please be aware these investments tend to be more volatile. No one knows what the future holds. I personally own each of these ETFs, and please understand that this is not a get-rich-quick video. In fact, one of the best investors of all time, Warren Buffett, says the stock market is a wonderfully efficient machine for transferring wealth from the impatient to the patient. Knowing that, my name's Sully, and all I ask is if you do find value in this content, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over the Schwab US Large Cap Growth ETF with the ticker SCHG. Now, before we dive deeper into the facts here, it's really important to understand that for all the investments I'm showing you in this video, the order I'm going to be using is based on the percentage of overlap that each ETF has with the standard stock market benchmark that is the S&P 500. And if you didn't know, the S&P 500 is pretty much a way to buy 500 of the largest publicly traded US-based companies, where you probably heard of most of the top ones like Nvidia, Microsoft, Apple, and Amazon that each have about 4 to 7% of weight in the index. Now, being referred to as the stock market benchmark, the S&P 500 has delivered an average annual return of just over 10% since 1957. And I bring this up because there are numerous growth ETFs like SCHG that have a significant overlap with the S&P 500, but are oriented towards solely the growth companies. For example, SCHG has 231 holdings, with the top companies being very similar to the S&P 500, but you can see the top 4 I mentioned now have between 6 to even up to 11% of weight toward the fund. Largely because of this, please be aware that SCHG has 123 companies that overlap the S&P 500, but more importantly, there is a 54% overlap by weight among their underlying holdings. Now, there are many other strong ETFs that you may personally prefer that I am not covering in this video because they all have significant overlap with the S&P 500. That would consist of Invesco's QQQM that has a 49% overlap by weight, Vanguard's VUG that has a 56% overlap, Vanguard's VONG that has a 60% overlap, and then Spider's SPYG that has a 67% overlap by weight. Each of those investments are all strong options, and there's even more that you may want to consider, but because of the significant overlap, I've stuck to just picking one for this video, and my choice came out to be SCHG. Of course, the choice is completely up to you, but of the many factors to consider, to start things off, SCHG tracks the Dow Jones US Large Cap Growth Total Stock Market Index that classifies the growth style companies it chooses based on 6 measures: 2 projected, 2 current, and 2 historical, that include the projected PE ratio, projected earnings, and many other factors that contribute to which companies are selected in the fund or not. And so SCHG has roughly 58% of weight toward its top 10 holdings alone, where 45% of the entire fund is exposed to the technology sector. SCHG is also super cheap with a 0.04% expense ratio, which means every $10,000 that you invest, it will cost you $4 per year in fees. It's literally nothing. And being ETFs, they are very tax efficient investments, especially for traditional brokerage accounts, but the fact that SCHG has a 0.39% dividend yield over the trailing 12 months is actually a great thing for those looking to let your investments grow over time and be as tax efficient as possible. The reason is that any dividend income you earn is taxed no matter if you reinvest the dividends or not, and that can lead to what's called tax drag, which can have a big impact on the long-term growth of your investments. SCHG also has an 18.08% standard deviation over the past 10 years when compared to the S&P 500 at 15.46%. Knowing that, the fund has also grown 17.2% over the past year. The past 3, it has averaged 21%. Past 5 was about 18.2%, and over the past 10 years, with the strong market that we've had, it has averaged 15.8%, where the S&P 500 over the same period has grown 12.8%. Crazy enough, if you had $100,000 invested in SCHG over the past 10 years, you would now have roughly $436,000. Which I'll also mention, SCHG's best year over the past 10 years was over 50% in growth, where the worst year was down 31.8%. We're looking at the S&P 500. As I discussed, there is typically going to be more volatility with growth-oriented companies, so be aware of the potential downside as well. But knowing that about SCHG and why I believe it is among the best overall growth ETF to consider, let's now go over the number 2, that is the Invesco S&P 500 Momentum ETF with the ticker SPMO. This one is really interesting because it is based on the S&P 500 Momentum Index that tracks the performance of stocks in the S&P 500 that have a high momentum score. The fund rebalances twice a year in March and September, and the companies are weighted based on their market cap and their momentum score. For this, Morningstar rates it a 5-star, and it has a total expense ratio of 0.13%, which is a bit higher, but for what you get, it can be very intriguing to you. And so with this fund, there is a total of 99 holdings, where the top companies consist of Nvidia, Facebook, Amazon, Broadcom, and JP Morgan, that each make up between 5 to 10% of the entire fund, where the overlap between SPMO and the S&P 500 is even less at 35% overlap by weight. Which, if you're worried about the overlap with SCHG, there are only 23 holdings that overlap, resulting in only 37% overlap by weight. Not to mention, but SPMO has less exposure to the technology sector, being roughly 22%, and it has a low dividend yield of 0.58%. On top of that, looking at the performance for SPMO, the fund is calculated to have a standard deviation of 16.45%, where over the past year, the fund has grown 30.52%. The past 3, it has averaged 24.7%, past 5 was 21.4%, and over the past 10 years, it has averaged a 16.78%. I'll also mention SPMO's best year over the past 10 years was up 45.8% in growth, where the worst year was down 10.46%. Now, if you didn't like SPMO, you may like the number 3, that is the Vanguard Information Technology ETF with the ticker VGT. This one, as the name implies, is a sector ETF that is based on solely technology stocks, and although it's not tailored for only growth tech stocks, I'm including it here because I view there to be a ton of growth potential in the technology sector, especially long-term with how the world is advancing. Now, VGT tracks the MSCI US Investable Market Infotech 2550 Index that currently has 319 companies in the fund, with top ones like Apple, Nvidia, Microsoft, Broadcom, and Salesforce, and it's really important to be aware of how much exposure is given to these top companies. Besides that, the top sectors include semiconductors and system software, where the fund has a 0.09% expense ratio, 0.48% dividend yield, and a 32% overlap with the S&P 500. VGT has also computed a standard deviation of 19.98%, where over the past year, the fund has grown just over 14%. Over the past 3, it has averaged 19.7%. The past 5 was 19.2%, and over the past 10 years, it has averaged 19.8%. I'll also mention VGT's best year over the past 10 years was 52.6% in growth, where the worst year was down 29.7%. All in all, if you believe in technology stocks long-term, this could be a solid option to consider, but be aware of the additional risk in that this is solely a sector ETF. And while speaking of risk, the next one may contain the highest amount of risk, but also the highest potential reward, and that is the VanEck Semiconductor ETF with the ticker SMH. As the name implies, this is also a sector ETF that is even more concentrated in solely semiconductor stocks, which plays a key role in the global economy, driven by their integral use in electronic devices and technology advancements in areas like AI and 5G that drive demand for more sophisticated chips. But be aware, this sector is highly cyclical based on supply-demand imbalances and geopolitical factors such as trade policies and global tensions. Now, SMH tracks the MVIS US listed semiconductor 25 index that currently has only 26 holdings. And this is crucial to understand because when you buy SMH, 20% of what you own is Nvidia, 10% is in the Taiwan Semiconductor Company, and right thereafter is also Broadcom. Crazy enough, the top 10 holdings make up 82% of the entire fund, So this by far has less diversification than other ETFs, and is why you need to be even more careful on how much you have allocated based on that. But before I cover its recent performance, understand that the fund comes with a higher cost, being a 0.35% expense ratio, a 0.38% dividend yield, with only a 12% overlap with the S&P 500. And so SMH computed its standard deviation that is 26.2%. Now over the past year, it's only returned a 0.13% of growth, where the past 3 it has averaged 26.1%, the past 5 was 28.5%, and over the past 10 years, it has averaged 24.5%. I'll also mention its best year over the past 10 years was 73.3% in growth, where the worst was down 33.5%. All in all, if you believe in semiconductors advancing over time and driving innovation in the modern world, this may be a solid option to consider, but be aware of it having the most volatility of all the ETFs mentioned. Knowing that, moving on to the number 5 growth ETF, that is the Avantis US Small Cap Value with the ticker AVUV. Now I know what you're thinking, and it is a value ETF, and yes, I am considering this as a growth ETF for this video, and my answer for that is because I'm going based off of the data. You see, one area that I learned a lot about small cap stocks is from the financial expert Paul Merriman, who has researched numerous comparisons on different indexes such as large cap stocks and small cap ones, as well as many other sectors. But the key takeaway here is that small cap value over the longest period of economic history among the US and even the entire world shows to have the highest average percentage of time the asset has performed the best. And the data gets even better the longer the time horizon that was researched. Another interesting point to compare is small cap blend to a small cap value and even a growth oriented index, where over the past 50 years, since 1972 to be exact, small cap value has achieved the highest returns of all 3 types. And what's even more unique about the ETF AVUV in particular is that it invests in a broad set of US small cap companies and is designed to increase expected returns by focusing on firms trading at what they believe are low valuations with higher profitability ratios. And so the fund has 786 holdings, which is the most of the 6 ETFs that I'm mentioning in this video, and the companies are selected based on the underlying index that is the Russell 2000 value, where the top companies here consist of ones like Five Below, Urban Outfitters, and many others that only contain a very small amount of weight to the fund, with a total from the top 10 being roughly 9%, and only 6% of the entire fund is weighted toward tech stocks. Now be aware that this fund has a 0.25% expense ratio, which is on the higher end, but is still significantly less when compared to many actively managed funds. The fund also has a 1.75% dividend yield, but interestingly enough, there is a 0% overlap between this fund and the S&P 500, which the fund is computed to have the highest standard deviation of 28.28%, where over the past year, it has only grown 2.31%, the past 3 it has averaged 6.7%, and the past 5 was 19.47%. And because this fund is relatively new, being created in 2019, there isn't enough data to go back 10 years. But the fund's best year was up 42.2%, and then the worst year was down 8.3%. Like I said, small cap value has proven to be among the greatest long-term investment, even passing the S&P 500, which is really hard to believe after its recent performance and overall credibility that it has being the largest companies and being referred to as the stock market benchmark. But do understand that there are many times that small cap value stocks actually underperform the rest of the market, and the excess returns in small cap value stocks tend to come in concentrated periods. Knowing that, the last one to mention here is the Invesco S&P MidCap Momentum ETF with the ticker XMMO. This ETF is also a very interesting one, similar to the S&P 500 Momentum ETF with Invesco that has the ticker of SPMO, but now this one is for mid-cap stocks where the index is composed of 80 securities within the S&P MidCap 400 index that is based on the highest momentum scores. The fund rebalances twice per year and has a total expense ratio of 0.34%, which is the highest of this video, but for what you get, it is at least interesting to know about. You see, of the 80 holdings, the top companies consist of Interactive Brokers at nearly 5%, and the rest with slightly less exposure that make up 30% of the entire fund. And with this fund, you are only exposed to about 8 to 9% to the technology sector, and the overlap between this and the S&P 500 is 0. The fund also has a 0.68% dividend yield, where it has a 19.75% standard deviation, a return over the past year of 9.3%, The average over the past 3 is 16.38%. Over the past 5, it is 16.7%. And the average over the past 10 is 15.18%. Not just that, but the best year was up 38% and the worst year was down 16%. All in all, by adding ETFs like this and the previous small cap value that is AVUV, I believe they are great additions to consider due to improving the overall diversification of your portfolio, especially because both of them have 0% overlap by weight with the S&P 500. Now I will say, because you've stayed this long into the video, I want you to know that I've created an entire index fund cheat sheet that simply shows all the data for each of these ETFs, as well as many other top ETFs that you may really want to know about and consider yourself. The cheat sheet is completely free, and I'll have it linked in the description below for you if you want to check it out. Besides that, I will also mention that if you want to start investing on a new platform, I'll have a link in the description below to some of the top options available in the market, which, depending on the one you get started with, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.